Most people only learn how markets really work after they lose money. Not from books, not from YouTube gurus, from the moment they're staring at a red screen, heart racing, wondering how something that felt so obvious went so wrong so fast. That's what this silver crash was. A lesson. A brutal one. And the worst part is, it didn't happen because silver suddenly became worthless. It happened because people misunderstood what they were actually buying. Let me start here, because this matters more than anything else you'll hear today. Why did you buy silver in the first place? Not the story you tell yourself now. The real reason. Were you buying metal to sit quietly in a safe for years, maybe decades? Or were you chasing a fast move, trying to turn a rally into quick profit? Those are two completely different games, and this crash punished anyone who mixed them up. If you were holding physical silver, bars, coins, something you can touch, nothing really happened to you. You still own the same ounces you owned last week. They didn't disappear, they didn't expire, they didn't get margin called. But if you were holding paper, leveraged ETFs, futures, options, anything borrowed or time limited, this move was lethal. That's not opinion, that's mechanics. Here's where most beginners get tripped up. They look at the spot price and think that's their break even. It isn't. If you bought physical silver, you didn't pay spot. You paid spot plus a premium, sometimes small, sometimes painfully large. That premium is real money, and it matters. If spot is $80 and you paid $92 all in, your break even isn't $80, it's $92. And if spot crashes to $70, it doesn't matter what CNBC says. You're underwater until price climbs back above what you actually paid. Most people never do that math. They just watch the screen and react emotionally. That's how bad decisions get made. Now layer leverage on top of that misunderstanding, and you get what we just witnessed. Here's what really caused this crash. Not a headline, not a Fed nomination, not a tweet. It was leverage stacked on top of leverage, sitting on top of a market that had already run too far, too fast. When prices rise steadily, people get confident, then they get aggressive, then they borrow. Futures, options, leveraged ETFs. The promise is always the same. Same move, bigger gains. What they don't tell you is that leverage doesn't just magnify profits, it magnifies time pressure. When exchanges raise margin requirements, and they did, aggressively, traders don't get a vote. They don't get a warning period. They don't get a second chance. They get a call. Put up more cash right now, or your position is closed for you. When thousands of traders get that call at the same time, selling isn't a choice anymore. It's forced. That's when prices don't drift down. They fall through floors like they were never there. Stops trigger. More selling, more margin calls, more liquidation. It feeds on itself. And here's the part that feels unfair, but is absolutely central to how markets work. When people need cash immediately, they don't sell what they want to sell. They sell what they can sell. Gold, silver, liquid assets. That's why assets that are supposed to protect you sometimes drop the fastest during panics. Not because they're broken, because they're liquid. This is exactly why comparing this move to March 2020 actually makes sense. Back then, everything sold off together. Stocks, bonds, gold, silver. Not because the world suddenly hated all assets at once, because leverage had to come out of the system immediately. What you just saw was that same plumbing problem, replayed in metals. Now here's where things get interesting, and where most people stop paying attention. While paper silver was collapsing, the physical market barely flinched. Coin shops didn't suddenly have piles of metal they couldn't sell. Delivery times didn't magically shorten, premiums didn't disappear. That tells you something important. If this were a real demand collapse, physical sellers would be panicking too. They aren't. This gap between what the screen says and what real metal costs is the quiet signal most people miss. Paper prices move fast because paper can be created and destroyed instantly. Physical doesn't work like that. Refineries don't double output overnight. Mines don't turn on like light switches. Manufacturers don't stop needing silver because a chart went red. That's why I keep saying this wasn't about silver the metal. It was about silver the trade. Now let me talk about something personal, because this is where theory meets reality. A few weeks ago, someone close to me was riding this rally hard. Not recklessly, just confidently. They'd been buying physical for years, slow and steady. But as prices climbed, the temptation crept in. What if I sell the metal and buy options? What if I use leverage just this once? That's the danger zone, because once you shift from ownership to speculation, the rules change. Physical metal doesn't care about your timing. Paper does. And when the drop came, it came fast enough to wipe out anyone who needed perfect timing to survive. That's the difference between being right and being solvent. Plenty of people were right about silver long term. They still lost money because they were wrong about the path. That's the lesson this crash is screaming at you. You don't need to predict the future perfectly. You need to survive volatility. Now what happens next? Anyone who gives you a precise price target is guessing. What matters isn't the next dollar up or down, it's behavior. Does selling slow down or accelerate? Do physical premiums stay firm or crack? Do traders stop getting forced out? Those answers don't come from headlines. They come from patience. Personally, this is not a moment for rushing. It's a moment for watching. Watching whether panic exhausts itself. Watching whether the forced sellers are gone. watching whether physical demand stays stubborn. Cash isn't cowardice here, it's optionality. Having dry powder when others are desperate is one of the few real edges individuals have. And one last thing, because this needs to be said, crashes don't destroy wealth, they move it, from impatient hands to patient ones, from leveraged players to unleveraged ones, from people who needed everything to go right, to people who planned for things to go wrong. Silver didn't stop being silver this week. Gold didn't stop being gold. What stopped working was leverage stacked on top of confidence, stacked on top of momentum. If you understand that, this crash becomes less frightening and more instructive. And if you don't, the next one will teach you the same lesson again. There's another mistake people make right after a crash like this, and it's subtle. They think the lesson is, silver is dangerous. It isn't. Volatility isn't danger by itself. Misunderstanding what you own is. Silver has always moved like this. Fast up, violent down, then quiet again. That's not a flaw. That's the nature of a market that sits at the intersection of money, industry, and speculation. What changed over the last year wasn't silver. It was how crowded the trade became. When something starts going up every day, people stop asking hard questions. They stop asking what could go wrong. They stop planning exits. They assume tomorrow will look like yesterday. That's when markets punish complacency. One thing that stood out to me during this crash was how many people didn't know their own exposure. They knew how much silver they had, but not how fragile the position actually was. If you're holding physical, your risk is time and patience. If you're holding paper, your risk is timing and liquidity. Those are not the same risks. A futures contract doesn't care if you believe in silver for the next 10 years. An option doesn't care how strong the long-term story is. A leveraged ETF doesn't care how convinced you are. They care about today, right now, this minute. That's why people who were right still got wiped out. Now zoom out for a second. Ask yourself this honestly. Did the world suddenly stop needing silver last week? Did solar panels stop getting built? Did electronics stop being manufactured? Did governments suddenly solve their debt problems? Of course not. The reasons people owned silver before the crash didn't disappear. Only the price did. And price is the most emotional part of the equation. That's why crashes feel personal. They hit your screen. They hit your account. They hit your confidence. But value doesn't move minute by minute. Value moves slowly, then all at once. This is where patience becomes a competitive advantage. Not the fake kind people talk about. The uncomfortable kind. The kind where you don't feel clever. You just feel calm. The market will tell you when this phase is over. Not through words, through behavior. When selling stops being frantic. When bad news stops pushing price lower. When physical demand refuses to back off even as paper stays weak. Those moments don't come with sirens, they come quietly, and most people miss them because they're exhausted, emotionally drained, or already out of the game. That's why survival matters more than prediction. You don't need to catch the exact bottom, you just need to still be standing when the dust settles. One more thing I want you to take seriously. Never commit everything at once. Not your capital, not your conviction. Spacing buys, leaving room for error, keeping flexibility. Those aren't signs of weakness, they're signs you respect uncertainty. Anyone telling you they know exactly what happens next is either lying or selling something. The honest answer is simpler. We don't know the path. We know the structure. We know leverage got flushed. We know forced selling did the damage. We know physical demand didn't vanish. That combination doesn't guarantee an immediate rebound, but it does tell you this wasn't the end of the story. If anything, it reset it. And resets are uncomfortable because they strip away fantasy. They force you to confront why you're in a trade in the first place. If you were here for a quick hit, this market just reminded you how unforgiving that can be. If you were here for long-term protection, it reminded you why volatility is the price you pay for assets that aren't someone else's liability. Neither path is wrong, confusing them is. So take a breath, turn off the noise, stop refreshing the chart every 5 minutes. Think in days, not hours, in structure, not headlines. The people who come out stronger from moments like this aren't the smartest or the fastest. They're the ones who didn't panic, didn't overreact, and didn't abandon their plan the moment things got uncomfortable. That's not exciting advice, but it works. And in markets like this, working beats being exciting every single time. I'll keep breaking this down as it unfolds, calmly, without hype, without fear. If this helped you think more clearly, stick around. That's the whole point of being here. I'll see you next time.